Welcome back to the deep dive. We are officially entering part 3 of our comprehensive breakdown of CapitaLand Integrated Commercial Trust, or CICT. If you've been following along with the previous discussions, you know we spent a lot of time on the business segment.
We did. We covered the qualitative side, the tenant mix, foot traffic, occupancy rates, and the broader macroeconomic positioning of their portfolio.
Exactly. But today we are pivoting. We are moving strictly away from the operational narratives and focusing entirely on the hard financial data. The math. Our mission today is to rigorously examine the updated July 2026 presentation deck, specifically unpacking the assets, returns, debts, and expenses. We're going to strictly analyze the percentages, the margins, and the capitalization structure to see the definitive financial reality of the trust. I need to formally note for you that this deep dive is prepared purely for educational and entertainment purposes. It's a sharing of research and opinion based on publicly available information. It is absolutely not financial advice. It is not an investment recommendation, and it is not an offer to deal in securities.
Absolutely. Neither of us are licensed financial advisors. You need to conduct your own due diligence.
Yeah, and past performance is strictly not indicative of future results. So, keeping a highly professional, direct tone today, let's jump right into the data. Okay, moving to the next slide. Let's look at the very first major data set, which is the distribution per unit, or DPU, on an FY basis. We need to talk about this 3-year DPU uptrend. The data outlines a precise sequence.
Right.
In financial year 2023, the DP started at 10.75 cents. Then, in FY24, it moved to 10.88 cents, which is a 1.2% year-over-year increase. And then in FY25, it arrived at 11.58 cents. That is a much steeper 6.4% year-over-year increase.
Which represents 3 straight years of defined growth. There are mathematically no downtrend flags visible in this specific snapshot. And, contextualizing this against their broader history, FY 2025 actually marked the 6th consecutive year of DPU growth since the pandemic.
Okay, but here's where I want to push back on that growth, and this ties back to the question I asked at the top of the show.
Yeah.
We need to analyze the exact drivers of that DPU growth, because when you cross-reference this with the income statement, there's a massive discrepancy in the growth rates.
You're looking at the top line versus the bottom line.
Exactly. Let me lay out the numbers. The distributable income for FY 2025 reached $860.9 million. That's a 14.4% year-over-year increase.
Right, 14.4%.
But if you look at the net property income, or NPI, it only rose by 3.1%. And the gross revenue, the actual rent collected, rose a mere 2.1%. So I need you to explain this mathematical gap. How do we bridge a 2.1% revenue increase to a 14.4% distributable income increase?
It's purely a function of capital structure mechanics. The gap between that 2.1% and the 14.4% is directly attributed to 2 non-operational factors: lower financing costs and the financial consolidation impact of the Kappa Spring buyout.
Okay, let's strictly break those down. Let's start with the lower financing costs.
Yeah.
How does that drive the DPU up when the rent isn't growing much?
It's basic income statement mechanics. Gross revenue flows down in net property income by subtracting operating expenses. To get from NPI to distributable income, you must subtract the interest expense on the trust's debt. By strategically reducing their aggregate cost of debt, the total interest expense decreases. That capital bypasses the property-level NPI calculation entirely and flows straight to the bottom-line distributable income. The DPU growth was engineered by capital management rather than organic rental growth at the property level.
Got it. Now, what about the Capita Spring buyout?
Right. So CICT previously held a joint venture stake in Capita Spring. That meant they only consolidated a fractional share of the asset's distributable income on their books.
But they bought out the remaining partners.
Exactly. When they executed the buyout, they began retaining 100% of the economic benefit of that asset. So the gross revenue at the property level didn't organically jump, but CICT's absolute share of the distributable income generated by that asset increased to 100%.
Okay, so a massive portion of that $860.9 million figure is just the accounting consolidation of a larger ownership stake, combined with debt cost optimization.
Precisely. It was portfolio reshaping, not an underlying surge in rental rates.
Which strictly defines the mechanics of the payout. Now, let's look at the yield metrics here. The slide details the distribution yield at 4.67%. It also presents the property yield for FY 2025 at 4.65%, and notes this is calculated as portfolio NPI over property value.
The proximity of those two numbers, 4.67% and 4.65%, is critical.
Why is that? What does it mathematically indicate?
It indicates that the positive leverage they're employing is perfectly offsetting the corporate-level expenses and management fees. The property yield is the strict asset-level return, unencumbered by corporate debt or fees. The distribution yield is the unitholder return. The fact that the capital structuring allows the unitholder to receive a yield almost perfectly identical to the raw asset yield shows extreme efficiency in their financial engineering.
That makes sense. Although, looking at this slide, there's no last 12 months or trailing 12 months DPU data available. It's just a blank space.
Right, and that's due to the reporting cadence. The first quarter FY 2026 business update from April 24, 2026 simply did not disclose a declared DPU.
Because they moved to a semi-annual distribution declaration, right?
Exactly. So without that Q1 declaration, calculating a strict rolling 12-month metric is impossible without making forward-looking assumptions, which this dataset strictly avoids. We're pending the first half FY 2026 results on August 12, 2026. Until then, the FY 2025 DPU of 11.58 cents is the mathematical baseline.
All right, moving to the next slide. Let's transition to the balance sheet. Specifically, the net asset value, or NAV, per unit data recorded as of December 31 for the respective financial years.
This dictates the underlying capitalization of the trust.
Yes. So let's look at the 3-year progression. In FY23, it was $2.07. In FY24, it moved to F$2.12. And in FY25, it rose to S$2.14. That represents a 3.4% cumulative increase. The slide concludes this indicates an absence of asset value erosion.
And mathematically, that is correct. A rising NAV means the gross asset values are accreting at a faster rate than liabilities are expanding, net of any equity dilution. It corresponds directly with stronger borrowing power.
Explain the mechanics of that borrowing power. Why does a higher NAV mathematically lead to more favorable terms for acquisitions and refinancing?
Because NAV represents the net equity buffer. When lenders price debt, they look strictly at the loan-to-value ratio. A higher NAV increases the denominator, the gross asset value, which lowers the effective portfolio leverage. This mathematically quantifiable reduction in credit risk directly translates to tighter credit spreads, meaning lower interest rates on new debt.
Okay, and looking at the public market valuation of that NAV, the slide points out the price-to-NAV ratio of 1.16x as of July 23, 2026. This is based on a unit price of S$2.48, so the units are trading at a premium to book value.
A 16% premium, yes,
Yeah.
Which is a structural advantage. Issuing new equity at S$2.48 to purchase underlying assets valued at S$2.14 is mathematically accretive to the existing unitholder NAV.
Right, but I have a pushback on this upward NAV trend. There's an adjusted NAV per unit figure of $2.07 recorded at June 30, 2025. That is a 1% dip versus the December 2024 figure.
Yeah.
Why the variance?
It's strictly an accounting function of the distribution cycle.
Meaning?
The half-year adjusted figure explicitly excludes distributable income. When the trust declares a distribution, that cash is reclassified on the balance sheet from an asset to a current liability, a distribution payable.
So taking a snapshot immediately after excluding that distributable income naturally results in a mathematically lower total asset base.
Precisely. It creates a different reporting basis, not a structural decline in the physical real estate valuation.
Okay, I have another pushback, pulling from the 2026 AGM. Management noted that NAV per unit rose 3.8% from 2021 to 2025. But over that exact same period, total borrowings rose approximately 25% to hit $10 billion. How do we interpret this mathematical divergence? A 25% debt increase for a 3.8% NAV increase.
You have to analyze the capitalization structure.
Yeah.
When you fund expansion with debt, the new asset value increases the total gross asset value by the exact amount of the new liability.
Right, so the net effect on absolute NAV dollars is zero at the point of transaction.
Exactly. So the 3.8% NAV per unit growth is derived from the subsequent capital appreciation of that expanded asset base. But because the existing equity denominator is so massive, there are billions of units in issue, a 25% increase in debt drives a much smaller percentage increase in net equity per unit. It simply reflects the leverage applied to a massive base during that period.
Okay, that clarifies the balance sheet. Moving to the next slide, let's transition into the debts and expenses data based on the March 31st, 2026 update. We need to look at the core metrics, starting with the cost of debt.
This is the critical variable.
The cost of debt is 2.9%. The data notes its decrease from 3.2% at the end of 2025. And this was specifically facilitated by the issuance of $300 million in green notes at 2.1% in March 2026.
Accessing 2.18% fixed-rate debt in this environment is purely a result of utilizing sustainability-linked financing frameworks. The institutional demand for ESG compliance drives the yield down, allowing them to pull their aggregate weighted average cost of debt down to 2.9%.
But here is where we have to isolate a very specific risk. I want to look at the yield spread. If we take the property yield of 4.65% and subtract this 2.9% cost of debt, we arrive at a spread of 1.75%.
Right.
Now, the source explicitly designates this 1.75% as a watch point, sitting below a 2% comfort line. Analyze the mechanical risk embedded here.
The 1.75% spread provides a very thin numerical cushion. A REIT relies on the positive arbitrage between asset yield and debt cost. If refinancing costs increase, say, new bonds price higher than 2.9%, or if capitalization rates soften and push the property yield down, that 1.75% margin compresses further.
And what happens if it compresses too much?
The mathematical viability of debt-funded acquisitions diminishes. If a new property acquisition yields less than the cost of the new debt required to buy it, plus corporate overhead, the transaction adds zero or even negative accretive value per dollar borrowed. That's why 2% is the comfort line.
Okay, let's look at the leverage ratios surrounding that debt. The gearing ratio is sitting precisely at 38.5%. And it notes that because there are no perpetual securities in issue, the perp-inclusive basis is identical.
Which confirms there are no hybrid equity maneuvers artificially depressing the stated leverage. It's a clean 38.5%.
And the interest coverage ratio, or ICR, is detailed at 3.8x, which is an improvement from 3.7x at the end of 2025. Adjusted ICR remains identical, again, due to the absence of hybrid securities.
Right, and that ICR improvement from 3.7x to 3.8x is the direct mathematical result of the aggregate cost of debt reducing to 2.9%. The interest expense denominator shrank, expanding the coverage ratio.
Let's look at capital structure stability. The data highlights that 76% of the $9.8 billion in total borrowings are on fixed rates, which is up from 74%, maintaining a position above their 70% policy floor.
That mathematically insulates 3/4 of their debt from short-term benchmark rate fluctuations. It ensures predictability in the interest expense line item.
And then there's the unencumbered assets metric. It stands at an exceptionally high 90.7% of total assets, well above their 80% threshold.
That preserves significant refinancing flexibility. If unsecured bond pricing becomes unfavorable, they have the mechanical ability to pledge those unencumbered assets to secure direct collateralized financing, usually at tighter credit spreads.
We also have the credit ratings confirmed as solid. Moody's A3 and S&P A, both with stable outlooks. Furthermore, 64.4%, which is $6.9 billion of the total debt, is classified as sustainability-linked or green financing,
which strictly verifies their capacity to meet financial commitments and proves their strategy of linking capital structure to sustainability targets to optimize debt costs.
All right, moving to the next slide. Let's direct our attention to the debt maturity profile, the interest rate sensitivity analysis, and the pro forma impact of their pending transactions.
Let's start with maturity.
The weighted average debt maturity is 4.0 years, unchanged quarter over quarter. It notes that 14% of borrowings mature by end FY 2027. Critically, no single year between FY 2026 and FY 2030 is free of debt maturities,
which indicates a deliberate fragmentation of refinancing requirements. By staggering the maturities sequentially, they avoid acute interest rate risk or liquidity shocks in any single fiscal year.
To contextualize those maturities, the expert macroeconomic data baseline provided in the deck notes the federal funds target rate was held at 3.5% to 3.75% on April 29, 2026. And the SORA, the Singapore overnight rate average, is stabilizing near multi-year lows at 1.0% to 1.3%.
Right, so the SORA stabilization caps the interest expense on the 24% of their debt that is floating rate. Meanwhile, the federal funds rate sets the risk-free baseline for when they issue new fixed-rate bonds to handle that 14% maturing by end FY 2027.
This leads perfectly into the sensitivity analysis. Management states that a 100 basis point increase in interest rates results in an $24.1 million rise in interest expense. This mathematically translates to a 0.32 cent drop in DPU. I want you to contextualize this drop strictly against the FY 2025 baseline we discussed earlier.
Sure. If you calculate that 0.32 cent reduction against the FY 2025 DPU of 11.58 cents, it represents just a 2.8% decrease.
Which is very low.
It is. It mathematically proved that because 76% of the debt is fixed and the overall cost is optimized at 2.9%, the distributions remain numerically well insulated from near-term rate volatility.
Okay, let's wrap up with the pro forma transaction impact. The precise mechanics involve the pending acquisition of Paragon at a 3.9% entry yield and the divestment of Asia Square Tower 2, or AST2, at a 3.0% exit yield.
Which is strict yield arbitrage.
Break down the math on that.
You are exchanging an asset yielding 3.0% for an asset yielding 3.9%. This positive spread drives a pro forma increase on the FY 2025 DPU of 2.1%, bringing it to 11.83 cents. It is definitively accretive at the asset level.
But looking at the corresponding balance sheet impact, the total capital required for this swap pushes the pro forma gearing ratio up from 38.5% to 39.2%.
Right, because the absolute capital required to acquire Paragon exceeds the proceeds from divesting AST2. The difference must be funded with new debt, which mechanically drives the overall gearing ratio up, consuming some of their debt headroom.
So, summarizing the strict financial reality presented in this deck, CICT displays a clear 3-year DPU uptrend reaching 11.58 cents, an increasing NAV of $2.14, and an optimized debt cost of 2.9%. However, the primary numerical constraint is that tight 1.75% yield spread against a gearing ratio climbing toward 40% post-transactions.
That is the exact mathematical summary of their position.
Thank you for joining us for part 3 of the CICT Deep Dive series. We will see you next time.